If you enjoyed this video, please press like and subscribe to the Daily Wins channel for more updates. Disclaimer. This video is for informational and entertainment purposes only. It is not financial advice. Please consult a qualified financial advisor before making investment decisions. The stock market can seem complex. It is not a private club. It is a place where people buy and sell tiny pieces of companies. These pieces are called shares or stocks. When you buy a share, you own a small part of that company. Many people invest hoping their shares will grow in value over time. This growth can help them achieve financial goals. It is a system built on supply, demand, and company performance. But it is not a guaranteed path to riches. Always remember that fundamental truth. North America is home to some of the world's largest stock markets. Think of the New York Stock Exchange, or NYSE. There is also the NASDAQ, famous for technology companies. Canada has its major market, the Toronto Stock Exchange, or TSX. Billions, even trillions of dollars change hands on these exchanges every single trading day. They reflect the health of many businesses, big and small, across various sectors. Understanding these major markets is key for any investor looking at this region of the global economy. Their movements can influence markets and investor sentiment far beyond their geographical borders. How do we know if the market is doing well or poorly overall? We use market indexes. These are like a carefully selected basket of representative stocks. The S&P 500, for instance, tracks 500 large U.S. companies. The Dow Jones Industrial Average follows 30 very big, well-known American firms. The NASDAQ Composite focuses on the tech-heavy NASDAQ-listed stocks. In Canada, the S&P/TSX Composite Index tracks Canadian equities broadly. These indexes give us a snapshot, a general idea of the market's prevailing direction. They are like a broad weather report for the financial world, not a specific forecast for individual stocks. Studying market trends can offer valuable insights. It might suggest whether it is a generally good or bad time to buy, sell, or simply hold your investments. Trends show the collective mood and actions of investors over a specific period. However, a crucial point must always be remembered by every investor, whether new or experienced. Past performance is not a crystal ball. It absolutely does not guarantee future results. Market trends are just one tool among many. Smart investing requires a broader view, careful consideration of your own circumstances, and a steadfast understanding of your personal risk tolerance. A moving average sounds technical, but the underlying idea is quite simple. It is the average price of a stock or an index calculated over a specific number of past trading days. For example, a 50-day moving average is the average closing price for the last 50 trading days. This calculation helps to smooth out the daily ups and downs, often referred to as the noise of the market. It makes it significantly easier to see the underlying trend with greater clarity. Think of it as drawing a smoother, more understandable line through volatile price charts, helping you see the broader financial forest. The 50-day moving average, or MA, is a popular short-term indicator used by many traders and analysts. It reflects recent market sentiment over roughly 2 months of active trading. If current market prices are consistently above the 50-day MA, it often suggests bullish or positive momentum in the near term. Conversely, if prices fall decisively below it, it might indicate bearish or negative short-term sentiment is taking hold. Traders watch this particular level very closely. It can act as a temporary support level when prices fall, or a resistance level when prices rise, offering clues about investor psychology. The 100-day moving average offers a medium-term perspective on market trends. It covers about 4 months of trading activity, providing a broader view than its 50-day counterpart. This average is less sensitive to very short-term price swings and sudden market reactions to daily news. It provides a more stable gauge of the market's intermediate trend, helping to confirm or deny shorter signals. Many investors consider the 100-day MA a significant level of interest. A consistent position above or below this line can often confirm a more sustained, broader trend, filtering out some of the fleeting noise. The 200-day moving average is a widely watched, long-term trend indicator, arguably one of the most important. It represents the average price over approximately the last 9 to 10 months of trading. Many professional analysts and large institutional investors consider this a critical line in the sand. If a market or a stock consistently trades above its 200-day MA, it is generally seen as being in a healthy, long-term uptrend. Conversely, trading below it for an extended period often signals a significant long-term downtrend. This average is a cornerstone for understanding the market's foundational strength or underlying weakness. Looking back at the North American stock markets over the past 20 trading days, up to today, May 21, 2025, the picture has been one of careful, somewhat hesitant movement. There has not been a dramatic surge upwards, nor has there been a frightening plunge into bear territory. Instead, major indices like the S&P 500 and the TSX Composite have shown what traders often call consolidation. This means prices have generally traded within a relatively defined range, moving sideways more than decisively up or down. Investors seem to be pausing, perhaps digesting recent economic data and corporate earnings reports. During these recent 20 days, market prices have had a very close relationship with their 50-day moving averages. For many key indices, current prices have frequently tested this important short-term level. Sometimes they dip slightly below it for a day or two, only to reclaim it shortly thereafter, demonstrating resilience. This flirting with the 50-day MA suggests a degree of short-term uncertainty in the market. Neither the bulls, who are optimistic investors, nor the bears, who are pessimistic ones, have gained decisive control in this immediate period. This often happens when the market awaits new, strong catalysts. The picture becomes a bit clearer, and perhaps slightly more optimistic, when we look at the 100-day moving average. For the most part, major North American indices have managed to stay above this key medium-term trend line during the last 20 days. While the activity around the 50-day MA showed some indecision, holding above the 100-day MA is generally interpreted as a more positive sign. It suggests that despite recent choppiness, the underlying strength observed over the past few months remains largely intact for now. The most encouraging signal for longer-term investors often comes from the 200-day moving average. Most broad market benchmarks in North America currently remain comfortably above this critical long-term indicator. This is a significant observation. As long as markets hold above their 200-day MAs, the prevailing long-term uptrend is generally considered to be in place. This technical observation often keeps long-term investors optimistic and can provide a psychological floor for prices. The current distance above it provides a helpful buffer against potential short-term pullbacks or corrections. The past 20 days haven't delivered massive, earth-shattering surprises for the overall North American market structure. However, there was a noticeable, albeit brief, period of heightened anxiety about 10 trading days ago. Some weaker-than-expected manufacturing data from a key economic region was released. This unexpected news caused a quick, sharp dip in technology stocks and industrial stocks in particular. The broader market seemed to wobble precariously for a day or two. But buying interest re-emerged fairly quickly, especially in more traditionally defensive sectors, and the indices recovered their footing. This highlighted market sensitivity to economic news. Overall, the North American stock market currently appears to be in a steady, albeit notably cautious phase, with a slight upward bias still perceptible. It is not aggressively rising at a rapid pace, but it is certainly not falling sharply or showing signs of a major downturn. The ability to hold above the 100-day and especially the crucial 200-day moving averages suggests an underlying resilience within the market. The hesitation observed around the 50-day MA indicates that investors are watchful and perhaps waiting for more clarity. They are weighing positive long-term signals against potential short-term headwinds. For new investors, this kind of market environment with its mixed signals can be particularly confusing. The most important lesson is not to overreact to daily news or short-term market jitters. Moving averages are helpful tools. They provide valuable context about trends and market psychology. However, they are not infallible predictors of the future because no single indicator is. Your investment decisions should always align with your long-term financial goals, your personal risk tolerance, and your investment time horizon. Avoid making impulsive buys or sells based on a few days of market movement. In summary, the North American stock markets have navigated the last 20 days with a sense of cautious stability. Prices have danced around short-term moving averages but have generally respected longer-term support levels, which is a positive sign. This suggests that while the immediate direction might seem uncertain, the broader positive trend established over many months still remains largely in effect. For anyone interested in stocks, the current environment underscores the timeless importance of continuous learning, proper diversification, and maintaining a patient long-term perspective. Markets will always fluctuate. Your strategy should be built to weather inevitable changes.